Welcome, everyone, and thank you for joining us on today's webinar. Today, we're going to talk about what's likely to be one of the most important retirement decisions you'll ever make. What should you do with your retirement money, like a 401k, 403b, or similar plan once you leave your job? A lot of people mistakenly think this is an easy choice, but that's rarely the case. Dependent upon your particular situation, you may have up to six different options to choose from. So today we're going to talk about each of those six options so that you can make the best decision for you and your family. We'll also shed some light on some common mistakes so that hopefully you can avoid them. Before we do that, let me tell you a little bit about myself. My name is Marc Bautis, and I'll be your instructor for today's webinar. I'm an independent financial advisor. I've been in the financial services industry for over 20 years. I authored a book on retirement planning called the Retirement Fitness Challenge, and I also host a weekly podcast, The Agent of Wealth, where we talk about everything personal finance and how to make better financial decisions. So now that you know a little bit about me, let's talk about the 6 rollover options when you leave your job. Dependent upon your specific circumstances, you may be able to leave your employer plan assets in your existing company retirement plan, roll over your plan assets to a new company retirement plan, roll over your plan assets to an IRA, take a lump sum distribution of your plan balance, convert your plan assets to a Roth IRA, or make an in-plan Roth conversion of your plan assets. In some cases, you'll be able to combine some of the options on this list. For example, you might decide to convert some of your plan funds to a Roth IRA and roll the rest over to a traditional IRA. We'll evaluate all 6 of these options with respect to fees and expenses, investment options, access to your funds, creditor protection, and more. The first option, and the most straightforward of the possibilities, is to leave your retirement funds in your current plan. If you choose to do nothing, you are essentially choosing this option. Of course, there are a number of reasons why you might intentionally leave your money in your plan too. Most of you will have this option available to you. There are a few times when the plan will force you to take a distribution, however. If you're lucky enough to be retiring early, or if you've otherwise left your former employer in the year you've turned 55 or later, you can take penalty-free distributions from the plan sponsored by the company you just left. This is different than the general rule, which says that you have to wait until you're 59 and a half to take penalty-free distributions. Once you're 59 and a half or older, this is no longer a concern. Similarly, certain federal, state, and local public safety workers can take penalty-free distributions from their plan at ages 50 or later. If creditor protection is a significant concern for you, that's another reason it may make sense to keep your money at your plan. Certain plans, like most 401k plans, offer creditor protection under the Employee Retirement Income Security Act. This is a federal law known as ERISA for short. ERISA offers very strong creditor protection and safeguards covered funds from the reach of most creditors. On the other hand, IRAs, Roth IRAs, and plans that don't receive creditor protection under ERISA receive creditor protection under state law. Thankfully, most states do provide these retirement funds with creditor protection that is roughly the equivalent to the protection provided by ERISA, but it's not always the case. You should always be aware of the fees that you're paying in your current plan and the difference, if any, of the fees you'll be paying if you move your retirement money elsewhere. Fees vary greatly from plan to plan, but in some cases, your plan may offer certain investments at lower cost than you can get elsewhere. Of course, the opposite may also be true. A rollover to an IRA or other retirement account could help lower fees. You simply have to look at these things on a case-by-case basis. And of course, it's important to consider the value you're receiving in conjunction with the fees you're paying, and not just the fees themselves. Fees are not always easy to tell in a plan like a 401k. A recent study by the National Association of Retirement Plan Participants found that 89% of 401k participants couldn't correctly calculate their own account fees, and 58% didn't even know there were fees. I would start off by asking for the participant fee disclosure document from your plan sponsor. Of course, no solution is going to be perfect all the time, and leaving with your money with your old employer is no exception. There are any number of reasons this might not make sense for you, some of which you can see here. 401ks are generally limited to 10 to 20 investment options. Or if you need help with your account, you may have to deal with a call center. There are certain estate planning strategies that exist in IRAs, but aren't available in 401ks. And there's also a chance that you'll wind up having a zombie 401k. This is a 401k that gets lost. And I see this numerous times with people every year. They had an old 401k that they forgot about. It seems like it would be hard to do, but people change where they live, companies merge, and just addresses get lost and people change their email addresses, and it actually happens more frequently than you would think. Sometimes it makes sense to move it solely for the benefit of consolidation. Okay, so far we've talked about why it might make sense to keep your money in your current plan, but many people choose to move their money elsewhere after they leave their job, either to another plan or more commonly to an IRA. So before we talk about why that may make sense for you, let's talk about how to move retirement money. In general, there are two ways that you can move retirement money from your plan to another retirement account. You can either move it indirectly in what's known as a 60-day rollover, or you can move it right from your plan to your new retirement account in what's known as a direct rollover. A direct rollover is generally the best way you want to move money. Let's see why. In an indirect rollover, you receive a distribution of your plan funds payable to you, or they sent it to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. Now, that 60 days may sound like a long time, but it can go by in what sounds like it's the blink of an eye. Let's face it, life happens, people get distracted, sick, simply forget. And if that happens and you miss the 60-day deadline, the distribution is taxable, and dependent upon your age, it may be subject to another 10% penalty. So even if you're on top of things and you complete your rollover within the 60-day window, there's another problem with most indirect rollovers. When Congress created the plan distribution rules, they wanted to make sure people didn't take their money and run. So they created a special rule that requires plans to withhold 20% of taxable distributions that are payable to you when those distributions are eligible for a rollover. So for instance, let's say you have $100,000 in your plan and you request a distribution for the entire amount. Your plan will actually send you a check for $80,000 and will withhold $20,000 of your balance for federal income taxes. Now, suppose you take that $80,000 and timely roll it over. Have you completed a full rollover of your plan distribution? Nope. Even though you only received $80,000 from the plan, $100,000 was actually distributed. So if you want to complete a full rollover and avoid any taxes on the distribution, you'll have to both roll over the $80,000 you received and make up the $20,000 withheld from other savings. And what if you don't have that $20,000 just lying around? Well, that's just too bad. And just imagine if your distribution is larger, say $500,000. In that case, in order to complete a full rollover, you'd have to come up with a whopping $100,000 to make up the amount withheld for income taxes. So let's look at an example. John requests a distribution from his plan on May 1st. On May 2nd, the plan sends him a check, and on May 10th, John receives the check in the mail. John has 60 days from May 10th or until July 9th to get his distribution back into another retirement account. Another example, John has $100,000 in his 401k plan and requests a distribution in the full amount. John's plan will send him a check for $80,000 and will automatically withhold $20,000 from income tax. If John rolls over the $80,000 he receives from his plan, he'll still owe tax on the $20,000 that was automatically withheld. In order to make up the complete rollover and avoid any tax, John must timely roll over the $80,000 he receives, and he must make up the $20,000 withheld from other savings. As you can see, there are some real problems with indirect rollovers. Thankfully, there's a better way to move your retirement money, and that's the direct rollover. In a direct rollover, your plan money is sent right from your plan to your new retirement account. Most importantly, there's no 60-day time limit to worry about, and there's no mandatory 20% withholding. Sometimes, though, a plan won't offer to send your money right to a new retirement account. They do, however, have to allow you to make a direct rollover. Typically, this is done by providing you with a check made payable to your new custodian. For example, the check might read Company X, custodian for the benefit of John Smith, IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There's no 60-day deadline and no mandatory withholding. That's true even if your plan sends you the check and has you forward it to your new custodian. All right, so now that we understand the different ways you can move retirement money, let's go back to exploring your retirement rollover options. If you go back to work for a new employer that offers a retirement plan, you may be able to roll over your plan funds into your new plan. Note that plans don't have to allow rollovers from other plans. So if this is something that appeals to you, be sure to check with your new plan to see what the rules are. The reason to roll over money to a new employer plan is that generally the same reasons you might consider leaving it in your old plan, such as the potential for stronger creditor protection, the possibility of purchasing life insurance with the plan funds, and possibility of lower fees. If this sounds like a lot of maybes, it is. When it comes to plans, the tax code is often far more liberal than a plan's own rules. So a lot, as I mentioned before, it varies plan to plan. In addition to the benefits we discussed before, there are a few other reasons why you might roll over your old plan funds into a new plan. One reason is if you need to take a loan from your retirement money. In some cases, you may be able to take a loan of up to $50,000 from your employer plan. In contrast, you cannot take a loan from an IRA or your old 401k plan. It's what's known as a prohibited transaction and comes with some very scary tax consequences. In fact, if you had $1 million in an IRA and borrowed just $1, your entire $1 million will be considered distributed and fully taxable to you. Another reason this could make sense is if you want to use your retirement money to purchase life insurance and your new plan allows for it. To be clear, this is where you purchase life insurance while your money is still inside your plan. Life insurance is a prohibited investment in an IRA, so you can't roll life insurance over to an IRA. A more practical reason you may roll money from an old employer's plan into a new plan is simply to consolidate your accounts. Many people, particularly as they get closer to retirement, try to simplify their lives. Rolling over money from your old plan to a new plan means one less account statement to keep track of, one less beneficiary form to keep track of, one less account to make sure the appropriate RMDs have been taken from. Well, you get the point here. Once again, this strategy is not for everyone. Since this is a very similar option to our first option, you'll notice many of the potential disadvantages are the same as the slide I showed you earlier. Okay, so the third option you have when you leave your plan, and one option that must be available to you, is a rollover to an IRA. This is the preferred option for many when they leave their employer for a variety of reasons. If you want, you can roll your funds over to an existing IRA. Alternatively, if you don't already have an IRA, or if you would like to move funds to a new account, you can open up a new IRA and roll your plan funds there. Perhaps the most common reason people choose to roll over their plan funds to an IRA is to broaden their choice of investment options. Many plans restrict participants to a dozen or so choices. You may have experienced this in your own plan. While the investments offered by your plan may be sufficient for your needs, many retirement savers prefer to expand their investment options by rolling over their funds to an IRA. Once inside an IRA, there are very few restrictions in what you can invest in. In fact, while your particular custodian may be more limiting, the tax code allows IRAs to invest in anything except life insurance, collectibles, and S-Corp stock. This can be really helpful to tailoring your retirement portfolio to your specific needs. Another common reason many retirees choose to roll over their plan funds to an IRA is to consolidate their retirement savings. A study released by the U.S. Department of Labor reported that baby boomers born between 1957 and 1964 held on average a staggering 11.3 jobs between ages of 18 and 46. Sure, it's unlikely that you've had 11 different employer plans, but you certainly could have participated in 2, 3, or even more plans over the course of your working career. An IRA can serve as a convenient collection point for these plans, leaving you with fewer accounts to keep track of and watch over. IRAs oftentimes offer more attractive withdrawal options than plans. With an IRA, for instance, you can generally request a distribution whenever you want one. If you leave your money in your old company plan or roll it over to your new one, you're stuck with that plan's rules. Your company plan might be flexible, but it may not be. Another big difference between company plans and IRAs on the withdrawal end is that there's no mandatory 20% withholding on IRA distributions. With IRAs, you can elect to withhold 10% of your distribution for federal income taxes, any amount more than 10%, or if you want to, you can even opt out of federal withholding altogether and have none of your IRA distribution withheld. Another nice thing about IRAs is that if you have more than one of them, you can calculate your RMD for each account, but take it from just one account. So for instance, if you have one account that you really like or that's earning a high rate of return and you want to leave it alone, and you have another account that you're less happy with, you can take the RMD for both IRAs from the IRA account you don't really care for as much. That's not the case for most plans though. The general rule for plans is that each RMD must be calculated and distributed separately. There is an exception to this rule, however, if you have multiple 403Bs. So here's a quick example of how that might work. Suppose John has 3 IRAs and his RMD for the 3 accounts are $5,000, $3,000, and $2,000 respectively. So that's a total of $10,000 that must be withdrawn. John can take the $10,000 from any one IRA or any combination of his IRAs as he pleases. Jane, on the other hand, has 3 401ks. Her RMDs for the 3 accounts have been calculated and are $5,000, $3,000, and $2,000 respectively. So that's a total of $10,000, just like John. The difference, however, is that in order to avoid penalties, Jane must take at least $5,000 from the first 401k and at least $3,000 from the second 401k and at least $2,000 from the third 401k. She cannot combine the RMDs and take them from just one account like John can. Rolling over your plan funds to an IRA also can provide some estate planning benefits, such as making it easier for beneficiaries after you're gone by consolidating accounts. On the other hand, in some cases, rolling your money to an IRA can be beneficial for the opposite reason. Doing so may allow you to split your account into multiple accounts, each left to a different beneficiary. That may be helpful in situations like the ones you see here. But some plans may not accept certain beneficiaries, such as trust. They may not allow you to use a customized beneficiary form or allow your beneficiaries to utilize certain strategies, such as disclaimer planning. Rolling your plan funds over to an IRA that allows for these options can help resolve some of those issues. And finally, we come to the last point you see, which is preserving the stretch IRA. This is an incredibly important concept, but one that's not often understood. As you can see, there are a number of potential benefits of rolling your plan money over to an IRA. So to review, those benefits may include a broader array of investment choices, more flexible distribution options, RMD aggregation across multiple IRAs, more estate planning flexibility, and the simple process for beneficiaries to preserve the stretch. When it comes down to it, all these things can be really summed up in one word, and that's control. In general, an IRA simply gives you more of it. But they're not perfect. As you can see here, there could be some downsides to making this move. We talked about most of them on the previous slides. There's also a lot more flexibility with investments inside an IRA, but sometimes people like the simplicity that 401ks offer. One of the popular 401k investment options that people like to use is called a target date fund, where you pick the fund year closest to the year that you plan to retire. So an example of this is if you plan on retiring in 2040, you would pick the 2040 fund and be done with it. It's great for simplicity inside your 401k, but sometimes it's not the best option for you. The fund company is basing all of its investment allocation decisions based on everyone's age who falls in that same target retirement date. But sometimes you may be more or less risky than that fund is. There's also usually an extra layer of expenses that gets included in these types of funds. All right, so let's move on to our fourth option, and that's simply taking the money out of your plan. This is often referred to as cashing out your plan or the nuclear option. In general, this is not a great idea because you'll have to add the distribution to your income for the year. You also lose the tax deferral on those funds. Remember, while your money is growing inside a retirement account, you don't have to pay any tax on any interest, dividend, or capital gains. Despite compelling reasons like this, an alarmingly high number of people still cash out their plan balances after they leave their employer. Now, I said it's generally not a good idea to cash out your plan, but that's not always the case. In fact, if you're lucky enough to have the right set of circumstances, cashing out your company plan might actually make a lot of sense. And that's because there are a number of tax breaks, like the tax break for net unrealized appreciation, that can offer big tax savings. But before we talk about these strategies, let me first explain what a lump distribution is. A lump sum distribution from a company plan means that your entire plan balance is paid to you in 1 year. Your account balance must be zero by the end of the year. If not, it's not a lump sum distribution, and you won't be able to utilize any of these special lump sum distribution tax breaks. By the way, the year here is a calendar year, not 365 days. Your distribution also has to take place after you have what's known as a triggering event. And there are 4 triggering events outlined by the tax code. They are death, which doesn't really help you out much, but could allow your plan beneficiaries to take advantage of that special tax breaks that we're going to discuss. Second triggering event is reaching the age of 59 and a half. There's also a separation from service, meaning that you've retired, resigned, or otherwise left your former employer. Note that this triggering event is not available for self-employed persons. So if that's you, sorry, you can't fire yourself to make this work. And fourth and last is if you're self-employed, however, disability is a triggering event. The definition of disability here is pretty restrictive though, so you just have to be careful with it. Okay, so now that we understand what a lump sum distribution is, let's talk about the strategies. We'll start with NUA since it's probably the most common. Sometimes company retirement plans, such as 401ks, allow you to invest your retirement money in your employer's own stock. So for example, if you work for ABC Corp, your ABC Corp's 401k might offer ABC Corp stock as an investment option. So if you decide to make such an investment, then any gain you earn on those shares inside the plan is known as net unrealized appreciation, or NUA, and it's eligible for the special NUA tax break. At its heart, the NUA strategy is a tax move that, for a portion of your retirement savings, allows you to trade the ordinary income tax rates you normally pay on retirement account distributions for long-term capital gains rates. And if you look at today's tax rates, this can be a savings of up to 20%. So how exactly does this NUA thing work? There are really just three important rules that must be followed, and we've already discussed two of them. The first rule is that everything must come out of your plan in one calendar year. The second rule is that the distribution must take place after a triggering event. And the final requirement is that your shares of company stock must be distributed in kind to a taxable account, such as an individual or joint account. They're not rolled over to another plan account or an IRA. That's a common mistake, and if you do it, you'll irrevocably lose the ability to make an NUA transaction. If your head is spinning right now, I wouldn't blame you. NUA is a pretty powerful strategy, but as you can see, it's also fairly complicated. You're probably not going to remember all the rules we just talked about, but that's okay. If all you take away from this part of the presentation is that the NUA is something you need to explore further, and you're still ways ahead of most people. And if you're not quite sure if it applies to you, let me simplify things by asking two questions. First, do you have stock in the company you work for inside your plan? If the answer is no, NUA is probably not something you need to concern yourself with. Second, has the company stock you purchased inside your plan appreciated or gone up in value significantly since it was purchased? If the answer here is no, then again, NUA probably is not something that you need to know about. There are other special tax breaks available for lump sum distributions too, such as 10-year averaging and pre-1974 capital gains elections. These are still lump sum distribution planning strategies, so the everything out in 1 year rule still applies. But I'm not going to spend too much time on these today because they don't really apply to that many people. But I do want to let you know they exist in case one or both of them could benefit you. Your takeaway here is that if you're eligible to take a lump sum distribution from your plan and you were born before 1936, or if you had money in your plan on December 31st, 1973, there could be additional tax breaks you may qualify for. But before making your rollover decision, you should be sure to explore them. And of course, while these strategies can be extremely powerful in some situations, they're not for everyone. Here are some reasons why they may not make sense for you. Okay, it's time to move on and talk about our fifth rollover option, a Roth IRA conversion. While this is certainly not going to be the best option for everyone, it is an option everyone has, and it's one that everyone should consider. In a Roth IRA conversion, funds go from your plan to a Roth IRA. Now, it's very important to understand that this is a taxable event, meaning the amount you convert will be added to your tax return for the year. For example, let's say Jane has $100,000 in a traditional 401k and would like to convert it to a Roth IRA. We'll talk more about why she might want to do that in a moment. If Jane moves forward with her Roth IRA conversion and converts her $100,000 plan balance, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jane happens to be at. Because this is a taxable event, it's always best to discuss this option with your tax and financial advisor beforehand. Now, at some point, you've probably heard that you should never pay taxes before you have to. That's a very traditional way of thinking, and while in some cases it may be true for you, there are a number of reasons why you may want to consider a Roth conversion. First and foremost is the potential for tax-free distributions from the Roth IRA in the future. If you're over 59 and a half and you've had any Roth IRA for more than 5 years, then all distributions from any of your Roth IRAs will be tax-free. If you're over 59 and a half but haven't had a Roth IRA for 5 years yet, you can still take out any of your converted amount tax-free at any time. If you're younger than 59 and a half, other rules apply. For instance, Suppose that Jane is 60 years old when she converts $100,000 to her first Roth IRA, and it grows to $300,000 by the time she's 70. If Jane wants to, she can take a distribution of the entire $300,000, and it will all be tax and penalty free. If Jane had needed money, say when she was 63 instead, which is within 5 years of opening her first Roth IRA, she still could have distributed up to $100,000 tax and penalty free. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. The last one, taxes, is a major concern for many retirees. A Roth IRA conversion can help you manage that risk by paying tax at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then that would be an indication that maybe this strategy isn't right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income. For instance, unlike supposedly tax-free municipal bond interest, tax-free Roth IRA distributions are not included in the calculation that determines how much of your Social Security income is taxable, so they can help minimize that expense. They can also help you keep other costs tied to your income lower, such as your Medicare Part B premiums. Another big benefit of the Roth IRA, and one that many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. So during your retirement, you can take as much or as little as you want. You're not forced to take anything at age 72 if you don't want to, like you are with a traditional IRA or an employer plan. That means your Roth IRA can continue to grow and compound tax-free for your heirs. That makes the Roth IRA a very intriguing vehicle from an estate planning perspective. And speaking of your beneficiaries, non-spouse beneficiaries like children do have RMDs from inherited Roth IRA accounts, but those distributions typically will generally be tax-free as well. Remember our stretch IRA example from earlier? Now imagine if all that was tax-free. You probably know what I'm about to say, right? That's right. Just like everything else we've talked about today, this strategy, as you can see here, is not for everyone. All right, we've come to our sixth and final option, and that's an in-plan Roth conversion. This is a relatively new option and is probably not available to all of you, but you should be aware of it just in case it applies to your particular situation. An in-plan Roth conversion, it's similar to a Roth IRA conversion in that you take pre-tax money, pay tax on it, and then have it in an account growing potentially tax-free for future use in retirement. The difference is that the conversion is made from the traditional side of your company plan to the Roth side of your plan. For example, if you have a 401k that allows in-plan conversions, converted funds would go into your Roth 401k account, not a Roth IRA. From a tax perspective, the impact on your tax return from a Roth IRA conversion and an in-plan Roth conversion are pretty much the same. You have to add that amount you convert to your income for that year, and if you meet certain guidelines, future distributions in retirement will be tax-free. So if you decide to make an in-plan Roth conversion after you retire, you're really making two choices. First, you're deciding that a Roth conversion makes sense for your tax planning over the long term, and we've already discussed why that might be. Second, you're deciding you're better off keeping your money in your plan than moving it to a Roth IRA. And if both of these statements are not true, one of the other 5 options we've discussed today is probably a better option for you. There are also some distinct disadvantages of in-plan Roth conversions compared to Roth IRA conversions. If some of these are important to you, you may want to make a Roth conversion. You may be better off converting it to a Roth IRA instead of an in-plan Roth conversion. Perhaps the biggest drawback of the in-plan conversion compared to a Roth IRA conversion is that there's no way to recharacterize the conversion. So if your tax bill is higher than expected, or your account value has dropped significantly since the conversion, or if you've otherwise changed your mind, too bad. You're stuck with the in-plan conversion and the resulting tax bill. Another big disadvantage of in-plan Roth conversions is that even after the conversion, minimum distributions are generally still required once you reach age 72. One of the major reasons that many people consider Roth conversions in the first place is to avoid RMDs and to allow their money to compound tax-free throughout their lifetime. That's generally not going to be the case with an in-plan Roth conversion, though. So if avoiding RMDs is important to you, a Roth IRA conversion may be the better solution for you. Okay, I promise this is the last time I'm going to say this today. This strategy isn't for everyone and comes with its unique set of drawbacks. As you probably realize by this point, the decision of what you do with the money you've accumulated in your employer plan, it's a lot more complicated than most people realize. Let's face it, your retirement plan assets likely represent years and possibly a lifetime worth of savings. Now is the time to protect and preserve those hard-earned assets, and that starts with making the right rollover decision. Few people are aware of all their potential options. Even fewer are aware of all the key issues surrounding those options. So you're already ahead of the game. Hopefully I've answered some of the questions you have today, but chances are you still have others. But that's okay. We're here to help you answer those important questions, evaluate your rollover options, and design a strategy that's best for you and your family. So you can schedule a free consultation with me at bautisfinancial.com/schedule a call. Also, I urge you, before you make any rollover decisions, if you're not going to consult with me, consult with a professional, whether it's an accountant or another financial advisor. Thank you again for joining me, and best of luck for continued success.